Welcome to the deep dive. We sift through your sources to pull out the key insights. Today, we're getting into something fascinating: money psychology. Basically, why our wallets often ignore our spreadsheets. For ages, economics just assumed we're all perfectly rational, logical actors making logical choices. But, well, the real world. It's got market bubbles, sudden crashes, personal finance decisions that just don't add up logically. So, our mission today is simple: give you a shortcut to understanding why that happens and maybe how you can use that knowledge.
That's a great way to put it, because this field, behavioral finance, it connects economics and psychology. It shows that, okay, maybe our financial behavior isn't always rational, but it's often irrational in very predictable ways.
Predictable ways. Okay, I like that. So if traditional economics kind of missed this, what was the big discovery, the thing that really changed how we look at financial decisions?
It really kicked off with prospect theory. Daniel Kahneman and Amos Tversky, their work, which won a Nobel Prize, by the way, it showed we judge outcomes based on gains and losses from a starting point, not just total wealth. And the absolute cornerstone is loss aversion.
Loss aversion, meaning we hate losing more than we like winning.
Exactly. The psychological kick from a loss. It's way stronger than the pleasure you get from an equivalent gain. Some research puts it at about twice as powerful. Losing a $100 bill just feels far, far worse than the buzz of finding one.
Oh, yeah, definitely. That feels intuitively right. So that strong aversion to loss. How else does that sort of skew things? Maybe how information gets presented.
You're heading towards the framing effect. Spot on. How information is presented or framed massively influences our choices. Think about an investment pitch. It might really highlight the potential upside, but kind of downplay the risk of losing your capital, even if those are, just two sides of the same coin for you, the investor. It nudges you.
Right. It guides your focus. It's subtle but powerful. And does this idea, this treating money differently depending on the context, connect to mental accounting? Is that related?
It's very related. Mental accounting is our habit of putting money into different mental boxes. We treat dollars differently based on where they came from or what we plan to use them for, which, economically speaking, makes no sense. A dollar is a dollar, right? It's fungible. But we don't act like it. Why else would someone, say, save religiously for a holiday fund, but then raid their emergency savings for something fun but not urgent?
Yeah, I can see that. Guilty as charged, probably. It feels different, even if logically it's the same money. Okay, so these are individual biases. How do these little quirks scale up? How do they impact, entire markets? Because that leads to big stuff, like bubbles and crashes.
That's where herd mentality becomes a huge factor. We're social creatures. Fundamentally, we look to the crowd. And that applies to finance, too. It's what fuels those big speculative bubbles. People jump into an asset just because everyone else is. They stop doing their own homework. And the flip side, it makes crashes worse. Fear spreads. Everyone sells because everyone else is selling. Look at the Silicon Valley Bank collapse in 2023. Fear, rumors, social media, boom, a massive bank run practically overnight.
Wow. So the crowd effect, it's powerful both on the way up and the way down. Okay, so if we know we're predictably irrational, how can we actually use this? How can you, listening, design things to make better financial choices?
Right. You can kind of weaponize your biases for good. Take managing debt. There's the debt snowball method. Pay off the smallest debt first. Mathematically, maybe it's not perfectly optimal. The avalanche method, hitting the highest interest rate first, saves more money on paper. But the snowball gives you quick wins. Those small victories feel good, right? They build momentum. That makes you more likely to actually stick with the plan. So the best strategy, that's also the one you'll actually follow through on.
That makes sense. You're hacking your own psychology. But what if someone is really disciplined? Should they just stick to the math, the avalanche method, even if it feels like a slog?
Absolutely, if that works for them. If you've got the discipline and the numbers motivate you, the avalanche method is mathematically superior, no question. But for many people, that psychological boost from the snowball is what keeps them in the game. It's about knowing yourself, knowing your own behavioral triggers.
Okay, self-awareness is key. And what about stopping impulsive spending? Can we use these ideas there?
Definitely. You can introduce intentional friction. Make it harder to spend impulsively. A really simple one. The 24-hour waiting period. For any non-essential buy over, say, $50 or $100, just wait a day. That pause lets the initial emotional urge cool down, lets your more rational brain catch up. You can also do things like unsubscribe from those tempting marketing emails, or even delete shopping apps off your phone. Reduce the cues, reduce the temptation.
This has been quite the deep dive. It's really clear how much our feelings and these mental shortcuts shape our financial reality.
It really does. And that means true financial literacy, it isn't just about spreadsheets and interest rates. It's also about financial self-awareness, understanding your emotional hot buttons, your blind spots, how ads or the news might be pushing you.
So take a moment and think about it. What financial habits do you have that might be driven more by emotion or by some of these biases we've talked about? Maybe reflecting on that is the first step towards using these insights to build a more resilient financial future for yourself.